Look, I don't know about you, but I have lost a tremendous amount of money in the stock market, from swing traded to buying options to even, I hate to say it, paying somebody for a Discord access to get their trade alerts. And I have found that the quote unquote safest, right, and lowest risk strategy is actually a really boring one. And I want to share it with you in today's video. And if you drop a comment down below, I'm also going to give you one of my ebooks completely for free, no opt-in, no strings attached. It's our buying versus selling options strategy guide. So let's go over the shoulder. And I'm the first one to tell you guys, all strategies do involve risk, some more risky than others. And I'm excited to share this one with you guys. So first and foremost, we have to understand what high level, what this strategy actually entails. Okay. Now, simply all we say is we are willing to buy 100 shares of a stock or an ETF at a price and date that we choose. Now, as far as safest options, right? When we think, what is the safest way to preserve our wealth and set ourselves up for success, right? I believe SPY is, okay? A SPY or a QQQ or some sort of ETF that is already pretty much diversified. So for example, with SPY, if we were going to do this strategy, I'm here just on Robinhood for our example, and I go to the trade SPY options and I click sell a put, and I go out 30 days, right? I'm going to go right at 31 days out. All I'm saying here is I'm willing to buy 100 shares of SPY, right, in 31 days at close. Now, I also get to name my price here. So for this example, obviously at the time of recording this, SPY is trading at $685, right? And let's say, you know what, I'd be comfortable buying it for $680, right? So $680 if it is trading at close. Now, for me taking on that risk, right, I would collect $770. Obviously not financial advice, results vary. These premiums are constantly changing, as you see on your screen right now. So I always like to see high level how my trades always look like. This is my cash secured put calculator, and I'm just going to put my premium that I'm collecting right there. Now my collateral, right, your brokerage isn't just going to let you be like, okay, you can buy 100 shares of SPY, but you don't actually have the money to back it up. Every options contract, right, is equal to 100 shares. That's just the rules of it, okay? So in this case, our brokerage is going to lock up $68,000 of our collateral for those 31 days. So I put my collateral here as $68,000. Now I'm getting about a 1%, a little over a 1% return on my money here, right? How am I getting that? I'm dividing my 770 by $68,000 for a 1% return. Let's talk about the risks, okay? The first and foremost risk that can happen is, let's say on the 28th, right? You open up your phone and you open the trade and you didn't do anything. Like you open up your phone on the 28th. If SPY is trading above $680, let's say it's 685, 700, whatever, it's continuing its bull trend, right? Your contract expires worthless, right? Meaning that $68,000 that you locked up is returned back to you. And then you move on to another opportunity, or just do the same thing for SPY the following month. The second thing that can happen, and this is the biggest risk of this strategy, right, is that if on the 28th SPY is trading below $680, let's say it's trading at $675 or $650, you are not getting your $68,000 back. Instead, you're getting 100 shares or 100 shares of SPY, okay, on a cost basis of $680, okay? So you have to understand that those are the risks. Now, why do I think this is a quote-unquote safer strategy? Well, number one, the worst case scenario in this situation is we end up getting assigned SPY. If we get assigned SPY, right, we may go through, let's say we are going through a bear market next month, right? And we get assigned and SPY is just continuing to work its way down, right? For me, I eliminate the biggest risk is that SPY has always recovered and continued to hit all-time highs. Now, obviously, past performance is not indicative of future results. We know that. But for me and my risk tolerance, I believe SPY will always come back and hit all-time highs. And you could see that here. For example, when we saw that big old drop here, right, in that end of March, April timeframe, right, I'm sure a lot of people were assigned cash secured puts at like 605 or around the 600s. And it dropped all the way down to 500, right? And people were probably assigned at like $600. But don't you think they're pretty happy right now, right? A couple months later, it's trading at $685. and then they're able to run their covered calls all along the way. And that's the strategy that's next, right? Let's say we do get assigned 100 shares of SPY here. Well, if that happens, what we then can do is click sell a call. Now our collateral isn't our money, our 68,000. Our collateral is our actual shares, right? We're now using our shares and putting them on the line. So for example, let's just say for simplicity, right? SPY is trading at, we own 100 shares of SPY at 685 for the sake of simplicity. And you know what? We're okay selling them at 690 in 30 days. Well, if we did that, and you want to make sure you have 100 shares, right, at least of the stock or ETF you're doing this on, we'd collect $950 of premium. Okay, again, that will change constantly. Let's put this into my covered call calculator. All these calculators are free. Second link in description. You got a 2-hour training on the Ark Options Strategy. Plus, you get my trade log that you could download for yourself, and you get all these calculators as well. Okay, so with that said, we're collecting $952 of premium. Now we're saying we're willing to sell them for 690 our shares, right? That's our strike of option. We put 690. Our purchase strike price, we said 685. I'll just keep it around what the current market value of SPY is. Let's say you bought 100 shares of SPY and you want to put that money to work or put those shares to work immediately. You can do it, right? And a lot of people do this, and you could see that our premium return here is a 1.39%. And how I'm getting that is my premium, the 952, divided by $68,500. Okay, and because I treat the collateral and shares, it's just money. It's money that I'm putting to work somewhere, okay? And you can see I get a premium return of about 1.39%. Now, there's a couple different strategies that you can go about with this. Now, for me, since this video, we're trying to talk about the safest plays, I believe running SPY wheel is quote unquote the safest play. Now, obviously, it has risks, like I told you. With the covered call, what the risk with this one is you are capping your upside. So let's say on close on the 28th, right? SPY is trading above 690. Let's say it's trading at 700. You're selling your shares at 690. But at close on the 28th, if it's trading below 690, right? Like 689, 688, you're not selling your shares. You get your shares back, and then you could run the play again, right? On your 100 shares and collect that premium. That premium is given to you upfront from the options buyer. So you've probably been an options buyer before if you watched this video. I know I have, and I strictly focus on selling options at this point and collect that premium slow and steady and let it compound. Now, with that said, you can do this play on stocks. Now, if you're going to go into the doing this on individual stocks, your risk is elevated, right? Your risk is elevated. You could see in my trade log here, when I'll zoom in here so we can all see it, right? You could see I have like for example, I have some cash secured puts, right? That's saying I'm willing to buy 100 shares of like a Kenview and Snapchat here, right? You could see I'm getting a 4.8% and a 4% return on my collateral in a 30-day period. Now, that is more high risk. When I say higher risk, this means there's a higher chance of assignment, meaning either getting assigned the shares or getting your shares called away and selling them. And you kind of weigh these risks for yourself. This is why I tell people, do this for a year and you can really make this strategy your own. Like, immerse yourself with a network of people doing this as well so you can bounce ideas off one another. But you could see we don't trade a lot, right? This is just in our public portfolio. You can see we've done about 15 to 20 trades just over the past few months, and I've had a very, very good return so far, if I do say so myself. But with that said, if you wanted to kind of take it to the next level, and this is probably, I would say, going to be my primary strategy during my quote unquote retirement years to essentially write myself a paycheck, is I'm primarily only going to be running the wheel strategy on SPY and most likely nothing else. Probably will be other stuff as well, because you obviously still want to get some nice returns. But what we can actually do is weeklies on SPY. So for example, if I go out here, I'm just going to close all this out and I go sell a put and I just go out, let's just say 7 days right here, right? I will primarily do weeklies, right? So in this specific situation, I get to now potentially trade 4 times a month as opposed to only, let's say, once a month, okay? Now, for example, right here, right, trading at 685, let's say I'm cool buying it at 680, right? I'm collecting $293. Now you're thinking to yourself, Pete, well, that's a lot less than what you got before. But again, this is weekly now. Okay, so if I put like, let's just say 295 is what we're getting on that. So put 295, right? We're locking up $68,000, but we're getting just about 0.5%, right, in a week, right? But this will be drastically higher, right? If I'm able to do this trade 4 times in a month, I'm getting now closer to 2% in a month, as opposed to the 1% doing it on a monthly. But the risk is higher. Now, the easiest way to kind of judge how risky you're being with this strategy is with something called the delta. Now, if we open up these options contract, doesn't matter what brokerage you use, you could see the delta right here. And the delta, basically for us option sellers, the easiest way to look at it is probability of assignment. So this being a 32, that basically means there's about 30% chance that on close on the 4th, I would actually have to buy SPY at $680, right? But I like to look at it differently. I look at it as a 70% chance that my contract is going to expire worthless, right? Meaning I don't have to buy the shares of SPY at $680. I get my $68,000 back, and then I immediately open another contract the following week immediately, right? And again, your returns typically on the weekly SPY wheel will be drastically higher, but also your assignments will happen more frequently as well, which is an okay thing, because if we own 100 shares of SPY, our returns are typically higher here. Why? Because let's say we say we're going to sell them for $690 here. Obviously, our premium's more, but then if we actually sell the shares, right, we get an appreciation profit as well, which adds to our portfolio, right, and allows us to compound even faster. So me personally, I'm not afraid of assignment on like a SPY or something, because I can eliminate the biggest risk of this strategy, and that's being stuck with a junk stock that we can never even run covered calls on after the fact. And especially during my retirement years, I'm gonna be needing something a lot safer, as opposed to kind of going into the degenerate things. Guys, if you enjoyed today's video, make sure to like and follow. Drop any questions that you have down below. I'm also going to send all of you that comment down below my free buying versus selling options ebook. And if you want all my calculators here for yourself to download completely for free, no strings attached, I give you the training to accompany this as well for about an hour and a half, teaching you the Ark Options Strategy, which combines 5 sources of premium income into one strategy, basically taking the wheel strategy to the next level. So click that second link in the description of today's video, guys. Remember, sell options, collect premiums, repeat. I'll see y'all tomorrow.